So the stock market has recently crashed. Well, some call it a correction, some call it a dip, but others call it an opportunity. While some look at it as the end of the world, others look at it as a great time to buy the stocks of companies that they really want to buy. So in this video, I'm going to talk about the different reactions people have. What's your own reaction to when the stock prices go down if you're an investor? How do your family and friends react? How do your coworkers react? How does the Uber driver react when you talk to him or her on your way to the airport? And then think about this. How does a millionaire react? How does a millionaire react to a drop in the stock prices? This video, we're going to go over that. I'm going to go over some reactions people have. And then I'm going to finish off the video with watching how a true master, a millionaire plus, looks at a stock correction and how to adjust and how to take advantage of it. Now, when most people think of a stock market crash, they think of this. They think of a sea of red, and all their favorite companies are tumbling, and the world is coming to an end. So let's look at it critically. Let's think about it, and let's see how others react first.
There is a sea of red in the US stocks right now. Friday was one of the worst days for the US stock market in over 4 years. The last time this happened was on March 16th, 2020, and we all know what happened then. The Rona came by. As of Friday, this stock market crash has wiped off $2.9 trillion worth of value. But what's causing all of this? Well, there's significant fear that the US is about to go into a recession because unemployment has been rising for the past few months, and the new unemployment figure came in a lot higher than what analysts were expecting at 4.1%. On top of that, job growth figures are a lot less. Now, all of this data does not mean that the US is guaranteed to go into a recession, because actually the US economy is still growing at 2.8%, which when you compare it to other countries, the US is actually doing pretty well. Now, don't get me wrong, I'm not underplaying how big the stock market crashed. I mean, the S&P 500 has tumbled off the cliff alongside the Nasdaq and even the Dow Jones. And you might be looking at your investment portfolio thinking that is a lot of red. Microsoft ended the week down on 5%. And Amazon nearly 10%. Apple's fine, but Apple's always fine. But generally across the board, it is all red.
Okay, so that was a really good video because he used a lot of buzzwords, a lot of the words that you will hear whenever there is a correction or a drop in the stock prices. Words like tumble, the stock prices tumbled, the market crashed, trillions of dollars lost in one day, black swan event. There's a lot of these buzzwords that really incites a lot of fear and panic, and it makes you want to keep watching it. What's happening next, right? So you have to keep in mind that those words are often used, and it really sensationalizes the topic. There are many reasons why the stock market has made that turn, and many believe that's just because there's a cycle to it, and as the prices go up and it inflates like a big bubble, then eventually the bubble pops, right? So there are many reasons, and it's good to keep in mind that you got to get through the sensationalism, you got to get through the buzzwords to really know what's happening out there. So let's see what's next.
Here's why the stock market crashed in 60 seconds. Let's talk about it. First reason is because of unemployment rates. As y'all can see above me, unemployment rose from 4.1% to 4.3% in the month of July. This made investors nervous about a recession coming, so they started selling all these stocks to make sure they have cash on the sidelines. Second reason is because the Japan stock market plummeted. The main reason the Japan stock market crumbled was because of one thing, and that is interest rates. Dating back all the way to 1990, Japan had a policy where you could borrow yen for 0% or damn near 0% interest. So investors in the US market decided that they're going to borrow yen, purchase US dollars with that yen, and then invest that money into the US stock market. That was all fine and dandy until Japan decided they're going to increase their interest rates. So when this happened, investors who used yen to get into the stock market started to panic because now their profits were being cut. So this led to panic selling in the stock market, which is why it turned to a sea of red when it came to all the big ETFs, stocks, etc. That's really it. It's all psychology. It's D-War. I'm out of here.
Okay, that was really good too, because here he talked a lot about Japan and the Japan market and how that has tumbled as well. That's the words that are used. So that points to the fact that this is a global economy, that it's not just things happening in the US, like US unemployment or inflation or other things, or a black swan event within the US. It's not just that. It's things that can happen in other countries, other central banks that see a lot of trouble, or wars that are happening, or a whole slew of things that are not only out of our personal control, but a lot of times out of our own country's control. And so there's always going to be something that is occurring that will ultimately affect the stock market because it's such a global economy. And the idea is not so much thinking about what's happening that's causing it, but more how are you going to react when the prices go down. So, next video.
What's going on with the stock market? The Dow has dropped 1,000 points. NASDAQ has lost close to 4%, and the S&P 500 is down over 3%. A couple of things are going on. Huge fear of recession in the United States, and this past Friday we got a hold of the job reports. The job reports didn't look so hot. There had already been a revision for the job goal to be 179,000 new jobs. Where did we land? 114,000 new jobs. And a lot of those jobs are government jobs, which doesn't feel right. And the other thing that's going on, something that usually happens with the Fed, they are being too slow. They're taking way too long to raise interest rates. Inflation was just transitory, and the Fed should have acted quicker, but it looks like they took way too long. We use our common sense. The stock market has crashed before. This is not the first time, and it certainly won't be the last time. And if the fundamentals are there, this is a great opportunity to look at really good companies. Time to buy shares at a discounted price. So it's actually a really good opportunity right now. So overall, headlines are going to be crazy and dramatic, but everybody can just stay calm, stay focused. Do not make any decisions based on fear, and just stay focused on the long term. So happy Monday to everybody. Don't get caught up in the hype.
Okay, so that was a really good video because she really summarized it well. The issues with recession and with significant drops in the stock price of some really good companies. You know, if you're not thinking about it, you would think, hey, this is terrible, right? But again, the whole point of this video is to know that there are many factors outside of your control that are going to continue to happen. But the key is to focus on what you can control, which is your own reaction. If something bad is happening, or at least that's what most people are thinking, that you got to see through it. See through that and see what the opportunity is on the other side of that. And just like she said, you want to keep a cool head, and you want to stick to the fundamentals and think about the companies that you invested in. And the smartest investors look at stocks not as a ticker symbol or a price, but rather a piece of a company. So if you have been looking at this company and you are looking at their balance sheet, you're looking at their income statements, you're looking at the income steadily rising every year, you're looking at how much debt they have and if it's going in the right direction. You look at the what Warren Buffett would call the moat. You know, you look at this company's competitive advantages compared to other companies in its field. And if you add all that up and that tells you, hey, this is a good company I want to invest in, then you wouldn't be worried about if the stock price goes down. In fact, you would like it if the stock price goes down because you are investing in the company, not the stock itself. You're investing in what that stock represents, which is a piece of that company. So what she's saying is to keep cool and stick to the fundamentals and make sure that you are thinking through it clearly and you're not panicking. So I said earlier that how you react is so important, and a big question is, how does the millionaire react? What is the millionaire's approach to a stock market crash, of which there have been many? And I find that there's no better person to hear from than who I consider the master. And to me, that's Peter Lynch. And so let me show you a couple of videos of Peter Lynch. Here's some key stats on him. So Peter Lynch is, he's obviously an investor and a philanthropist and a mutual fund manager. He was the manager for the Magellan Fund, which is a part of Fidelity Investments. And that was between 1977 and 1990. So he had approximately a 13-year run. And on that, in that run, he averaged a 29.2% annual return, consistently more than double the S&P 500 in the stock market index. So he was also known, basically the Magellan Fund was considered one of the most successful, if not the successful, best performing mutual fund in the world, especially at that time. And a real key stat was that the assets under management, AUM, assets under management of the fund that he was running, had increased in the time he was there, increased from a total value of 18 million to 14 billion under his leadership and under his investment approach. So if there's someone that I'm going to listen to when it comes to an approach to stocks, not individual stocks like, oh, which stock should I invest in, but just an overall approach to the stock market and how to invest in it, Peter Lynch is the guy. So let's see what Peter said in this real iconic interview. It was more like a presentation that has been seen many times. So here he goes.
What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great.
So it's that simple. And stock prices in the market goes down sometimes, like it says. And what's very important is the wording that he used. He said, we call it a correction. And he made a joke out of it. That's a pretty funny one, but he says we call it a correction. And when I hear the word correction, I think, oh, that's something that either is supposed to happen, or I really shouldn't be surprised if it happens, whether it's supposed to happen or not. If it does happen, okay. And I think that's exactly what he was trying to say, is that it's a correction. He didn't use the word a meltdown or a catastrophe, or I don't think I've ever heard him say the word crash, but maybe I'm wrong, but that just would not fit his thinking. He thinks of it as a correction and an opportunity to buy parts of companies that he has really liked for a long time, and he has watched over years until that stock price represents a real discount compared to the value of that stock, of the value of that piece of that company that he's been studying. So Peter Lynch, he's the epitome of the investor who really studies the companies, looks at the financial statements, listens in on those earnings calls. And so he is very familiar with what he is investing in. And he says that a lot. Know what you're investing in. Know what you've bought. So here's another video with him, a little bit older, maybe a couple decades later, but you're going to find something interesting in this video, and that is that he has pretty much the same thought process his entire investing career. So.
It bothers me that people are very dangerous when they invest. This word play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or at a party. That's dangerous.
So that too really summarizes his approach. So when I say, what is the millionaire's approach? I mean, Peter Lynch is the millionaire many times over, right? So what is the millionaire's approach? It is exactly that. It's knowing what you're buying, and you're not gambling, you're not playing the market. And what he says in other videos and in other interviews is, if you don't know what you've purchased, let's say you purchased a stock at $20, but you don't really know that company. You don't really know the leadership. You don't know their advantages. You don't know their finances. If you don't really know that stuff, then if the price goes down to 15, then what do? Do you sell it, or do you buy more? And that's the fundamental difference in what we were talking about earlier, is the reactions. The reactions to price drop. Do you panic and sell, or do you buy? Well, if you're Peter Lynch or any other person who has become a millionaire through investing, you will know that the answer is know what you're buying, so that when the opportunity arises and the price drops, you look at it as a discount, an opportunity to buy more, because you are committed to the value of that company, and the stock that is just a means to get a piece of that company that you yourself have researched, and you believe that company is very strong in its fundamentals. So I hope this video has provided some valuable insight for you to see how a millionaire looks at stock investing, especially during a stock market crash or a correction or a dip or whatever it's going to be called. And it happens a lot. And in history, the most successful investors have been the ones who know what they're buying, they know what they own. And so when an opportunity comes to purchase that same asset for a discount, that they will take advantage of it because they've been prepared and they did not panic. So I hope this video has helped you. If you like this type of content, definitely give me a like in the video, and that would definitely help the channel, and subscribe to the channel, and I'll see you on the next video.